Yeah. You're not the type of girl to remain with the guy too shy, too afraid to say he'll give his heart to you forever. I'm not the boy that will fall to his knees with the sans class type begging you please to stay with him for worse or for better. But I'm staring at you now, there's no one else around. I'm thinking you're the girl for me. I'm just saying it's fine by me if you never leave, and we can live like this forever. It's fine by me.
Okay, in this last video, let's take a look at some yields, some different terminology about bond yields and distinguish between some of them. A bond yield is simply an interest rate. It's the current market rate for a bond. So if you hear about an interest rate for a bond, that's going to be the yield to maturity. The bond yield, all of these things are synonymous. So anytime we're solving for the interest rate, we're just going to solve for I once we're given all the other inputs. And we need to make sure that we adjust the interest rate solution that we get based on the size of the periods, how many periods there are per year. The yield to maturity is simply the interest rate earned on a bond if it's held to maturity. And again, there's this underlying assumption that all the interest payments that the investor receives are reinvested at that same rate, the yield to maturity interest rate. Yield to call is another yield, another possible yield. And this time it's the interest rate earned if the bond is called away from the investor prior to maturity. So in order to figure out the yield to call, we're just going to solve for the interest rate, solve for I, based on the bond being called. So that's going to mean that the future value will usually include a premium, so it will typically be above $1,000. It'll be above the face value of the bond. And we're going to modify the N to be based on the call date as opposed to the maturity date. So let's take a look at the spreadsheet and see an example. So for a yield to call, so we're going to determine the yield to call for a bond that's priced at $1,010. If the call premium is $50, the maturity is in 20 years, the interest payments are $34.50 every 6 months, and the bond is called away in 6 years' time. So we are given 4 inputs. The price, we have a negative 1010. The future value is going to be $10.50, the $1,000 face value of the bond plus the $50 premium. The number of periods is going to be 6 times 2, so 6 years, 2 periods per year, so we'll have 12 periods. The payment we're given is $34.50 every 6 months, so we're going to solve for the interest rate. In order to get that, we're just going to use the formula rate, where the number of periods is the first input, the payment is the second input, the present value is the third, future value is the fourth. We'll solve for that. Mine's already formatted to 2 decimal places. But also, and again one more time, keep in mind that this interest rate that we just solved for here is a semi-annual rate, and so we need to double that. And that's what we're doing with this formula here. I'm just doubling the cell to the left. And so our answer, the yield to call, would be 7.37%. The next yield to talk about is the current yield. It's a little bit different measure. And again, if all you hear is yield, think interest rate, think yield to maturity. But it's whenever yields have a modifier in them that we need to think about other things. So a yield to call is going to be different than a yield to maturity. And a current yield, again, is a different thing. A current yield on a bond. It's equal to the annual interest earned, so the annual coupon, divided by the current price of the bond. So again, let's go to the spreadsheet and look at current yield here. We're asked, what is the current yield for a bond if the semi-annual coupon payments are $23.50, the interest rate on the bond is 5.29%, and the time to maturity is 7 years. Because the current yield definition is the annual coupons divided by the price, we're given the coupons, we don't know the price, we're going to have to solve for that. And so thankfully we have the sufficient inputs here. The face value of the bond is $1,000, that's our default. The number of periods is 14. It's going to be 7 years times 2 periods per year. The interest rate we're given is 5.29%. We're going to divide that by 2 to reflect the semi-annual nature of the coupon payments. And we're given the payments as being $23.50. So we can use those inputs, solve for the present value, where the first input is the rate, the periodic rate. The second input is the number of periods. The third input is the payments. The fourth is the future value of the bond. And we would get a price of $965.86. Now we have sufficient information to figure out the current yield. That formula is simply equal to the annual coupons. So we're going to need to multiply the semi-annual coupons times 2. And we're going to divide that by the price. And I'm going to put a negative sign here to reflect that the price is $965.86. We don't want to have a, and there is not a current yield that's negative here. So I just put the negative sign in there to correct things. And so the current yield is equal to 4.87%. It's equivalent to a dividend yield for a stock. So 4.87%, it's different, notice, than the yield of maturity. We're given that in the problem. The interest rate on the bond is 5.29%. That's the yield of maturity. And notice we've got something different as well with the coupon rate. The coupon rate we can figure out is 4.7%. It's simply equal to the coupon payment multiplied times 2. And we're going to divide that by the face value of the bond. So we come up with an answer of 4.7%. So in this example, we have 3 different interest rates. And because we have 3 different terms that we're dealing with, the current yield has a particular definition, the yield of maturity has a particular definition, and the coupon rate, again, has a particular definition. All 3 of these are true. All 3 of these interest rates relate to this bond, but each of them has a different name and a different definition. So it's important to keep these straight. Well, let's keep moving here. I guess one thing to keep in mind, the total return on a bond, the total rate earned over the course of the year, the holding period return, is equal to the current yield on the bond plus any capital gains yield that you have by virtue of a price increase or decrease. So let's take a look at another bond example here. We've got a bond priced at $904.76. It pays us $19.50 quarterly, and it matures in 5 years. What's the current yield on the bond, and what's the yield of maturity on the bond? So finally, let's look at the expected change in price in 1 year if interest rates don't change. So we have a few different things to answer here with this example. So we're given a price of $904.76. We've got coupon payments of $19.50. That's per period, so we need to adjust the number of years to a number of periods. We're told that the bond matures in 5 years. So in order to get that, we're just going to multiply 5 years times 4 quarters per year. We have a total number of periods of 20. Face value, future value of the bond is $1,000 by default. And so we're going to solve for the rate, the periodic rate of this bond. The first input is the number of periods, which is here, payments, the present value, and the future value. So we get the yield of maturity rate as being 2.56%. We need to multiply that times 4 because the 2.56 solution that we had was a quarterly rate. We need to annualize that, so multiply it times 4 and we got 10.26%. That's the yield of maturity on the bond. First we were asked, what is the current yield on the bond? So in order to get that, we could take the payments multiplied times 4 and then divide by the current price with a little adjustment for the negative there. I would want to format that. And so the current yield is 8.62%. Was the first question that we were asked. The second question we were asked is, what is the yield of maturity on the bond? So that's 10.26%. And then last we were asked, what is the expected change in price in 1 year if interest rates don't change? So that's what I'm doing over here in this area. We're going to solve for the price given these 4 parameters. So we've still got a face value of $1,000. The number of periods is going to be reduced now. we're doing this as of 1 year later, so we have 4 years with 4 quarters per year, so our total number of periods is 16. The periodic interest rate is 2.56%. The payments are $19.50, and so I'll just solve for the present value of the bond. That's $920.16. And so the bond is increasing in price. It's gone up by $15.50 about, even without any changes in interest rates. And this goes back to something I mentioned a few slides ago, I think maybe in the prior video, that is that discount bonds over time will converge to the face value of the bond. So discount bonds, in the last case, or last year, it was priced at $904. It's gradually moving up to $1,000 as we get closer to maturity. Let's look at what the capital gains yield for this bond was. That's going to be equal to $15.40 was the price increase. In order to get a capital gains yield, we're going to take this number and divide it by the starting price. Again, I want to format that to an interest rate. And so my capital gains yield was 1.7%. The current yield on the bond was 8.62, and the total return was a little over 10.3%. Okay, let's look at, in wrapping up this video, some interest rate determinants, the things that go into making the interest rate that investors require on a bond. That's also the yield to maturity, same idea. It's also the discount rate for a bond. So the things that go into that are the real interest rate, denoted by R star. It's the rate of interest that would exist on a riskless security without any inflation. So it's an increase in the purchasing power of dollars, that sort of thing. An inflation premium is also included. Bond investors want to be paid for expected inflation over the life of the bond, so that's going to be tacked into the interest rate that they earn. There's a default risk premium that goes into the interest rate or the yield that investors get. The default risk premium reflects the risk that the firm will not pay back some or all of the money that is owed to lenders, to investors in the bond. Credit ratings reflect this component, so firms with AAA ratings, with the highest investment grade ratings, are going to have a lower default risk perception and also a lower default risk premium. There's going to be a lower interest rate required for those bonds and those borrowers. The default risk is a function of several things. Among those are the leverage of the firm, so how much debt a firm has. Everything else being equal, firms with higher leverage are going to have lower credit ratings, are going to have a higher default risk. The coverage and liquidity of the firm, so the firm's ability to pay interest and pay their bills on time, is also going to affect their credit rating and their default risk premium. If you have plenty of coverage on your interest obligations, if you have high liquidity, you're going to have a better credit rating, everything else being equal, and a lower default risk premium. And also profitability or free cash flow for a firm. The more profitable a firm is, the better its credit rating is going to be, the lower the default risk premium would be. Another factor affecting the default risk premium would be whether the debt is subordinated. That is to say, where it stands in line. Not all debt is necessarily equal for a firm. Some debt obligations of the firm have seniority, so they get paid first. So if debt is subordinate, if it's a debenture bond and it is kind of a general obligation of the firm, it may be at the back of the line in terms of the debt, and if there's not sufficient assets, not sufficient cash flows for the firm to pay all of the debts, the subordinated debt would not get paid in full. They may lose some or all of their principal. So all these things affect the default risk premium and ultimately the interest rate that investors demand for that bond. Liquidity premium is another component. It reflects the lack of liquidity for a firm's bonds. If it's hard to buy and sell bonds, I guess particularly I should say hard to sell a bond, investors will demand a liquidity premium. They're going to demand a higher interest rate to reflect the risk that they're taking on in in their diminished ability to sell the bond whenever they want to have cash flows. And finally, the maturity risk premium. This is the component of the total yield on a bond that reflects the risk of interest rate changes over time. The longer the time to maturity, the higher the uncertainties that an investor in the bond faces. And so the higher the interest rate that they're going to require, and that effectively means the higher the maturity risk premium is included in the bond. So we're left with this equation here. The total yield on a bond is equal to the real interest rate plus the inflation premium plus the default risk premium plus the liquidity premium, and finally adding in a maturity risk premium. So all those components make up the interest rate on the bond. They determine the yield to maturity required by investors. And that's the end of this set of videos on bonds, and we'll see you next time.
Oh, Mickey, you're so fine, you blow my mind. Hey, Mickey, hey, Mickey. Oh, Mickey, you're so fine,
and you're mine. I'll be yours till the end of time, 'cause you made me feel, yeah, you made me feel so shiny and new, like a virgin, touched for the very first time, like the one in me. That's okay, let's see how you do it. Put up your deuce, let's get down to it. Hit me with your best shot. Why don't you hit me with your best shot?